Hello, everyone. Welcome today to our educational webinar on IRA investing in small business. My name is Corey Daharsh. I'm with Advanta IRA, and my guest speaker today is Jason Ehrlich with Fruition Capital. Just a little bit of background about Jason. He's the founder and principal of Fruition Capital, which provides private investors with the ability to capitalize on the once-in-a-generation transfer of business ownership occurring as baby boomers age into retirement. These operating businesses with long track records of stable performance provide an excellent balance of cash flow and appreciation with a very low correlation to the performance of publicly traded equities. This in itself is a great topic for those of you that are interested in making investments outside of stocks, bonds, and mutual funds, which is really our niche market in self-directed investing. So I'm very happy to have Jason on. He's going to speak about his expertise, where I'm going to start just giving you some general information about alternative investing in retirement accounts. Jason, thank you very much for joining me today, and I look forward to sharing the audience with your presentation a little bit later. So today's agenda, again, my name is Corey with Advanta IRA. I'm going to cover for you guys exactly what a self-directed retirement account is and why people choose to start using these type of accounts for their retirement investing. I'm going to give you a general case study on how to make the type of investment that Jason's going to be describing in his portion of the presentation. And then after my case study, I'm going to turn it over to Jason, and he's going to cover investing in small business with acquisition entrepreneurs. After that is concluded, we're going to go ahead and flip over and take questions and answers. So please, if you do have any questions, we are going to keep our audience muted through the duration of today's webinar, but we do implore you to use the question box in GoToWebinar to jot those down, and we will address those at the end of today's session. Another piece of housekeeping I'd like to share, I do have a copy of the slide deck from today in the handouts section of your GoToWebinar task panel. So if you would like to download a copy of the PDF format of our presentation today, please find that in the handout section, or you could email or call Jason or myself to get a hold of that. We'd be very happy to share it with you directly. A little bit about Advanta IRA. We are a self-directed IRA administrator that has been in business for 20 years now in 2023. We have about 10,000 active clients and about 2.5 billion in assets under management. All of our clients' funds that are not actively invested are insured up to FDIC limits, and all of our clients are specifically paired with a dedicated client account manager. So you have a one-to-one person to reach out to if you have questions, have a new investment, have any specific inquiries about your account. You don't have to call a wire center and deal with a different person every time you reach out to speak with your representative. You'll have a go-to person that you get familiar with and that gets familiar with you to make things as smooth and simple for your self-directed journey as possible. So if you have not heard about self-directed investing, that's actually pretty common. These accounts are not so popular because those larger fiduciary or financial advisor custodians prefer to shy away from letting you know this even exists, and they do control, for the most part, the retirement account market. Only about 4% of retirement accounts in the US are self-directed, and the grand total, roughly speaking, is about $40 trillion in US-based IRAs, 401ks, retirement plans in general. And speaking about the different plan options that are out there, you are probably familiar with the traditional and a Roth IRA. Those are commonly known retirement products. We also offer SEP and simple IRAs and solo 401k plans if you're a small business owner. We also offer health savings and education savings accounts that can be self-directed if you either are someone that qualifies for a high deductible health policy or have a young one in your life that you'd like to set aside some educational savings for so that they can pay for whether it's graduate school or undergraduate school, or even at the younger levels for private schooling as they're going through their general education. All in all, any of the plans I'm showing here on the screen can be self-directed. So if you have one of those types of plans or have the ability to start one of those plans, you can definitely use that money to make tax sheltered or tax advantaged investments with your retirement funds. Again, outside of the investments that you maybe thought were the only options out there, stocks, bonds, and mutual funds. These are alternative investments that you can make into really any asset class that you would like. So why do people choose to self-direct once they learn a little bit more about what it is and how it exists? First is the tax benefit. Making investments with a tax sheltered retirement account means that you're growing your profits either on a tax deferred basis, such that you'll pay the taxes later in life when you distribute the money out of the retirement account, or a completely tax-free basis if you happen to be utilizing one of the Roth style accounts, meaning you've already paid taxes on the money in that account, or even the HSA account, which is actually known as a triple tax advantaged account. You get a tax write-off when you put money into that account. The money grows in a tax deferred capacity. And as long as you take the money out for qualified medical expenses, you're taking that money out completely tax-free as well. So the tax benefits are a significant advantage to using your retirement funds for investing. The stock market fatigue is also a common advantage that's been talked about a lot lately over the past few years, to be honest. People are just getting tired of the fluctuation of the stock bonds and mutual funds going up and down, or maybe for the most part down lately. So people switch over, at least diversify their portfolio with alternative investing, because this is a new source of capital. If you've already been investing in certain criteria or certain areas with your personal money, learning that you can use your retirement funds to further your investment goals in that avenue are going to help you build your overall nest egg and your overall wealth. So why are these a good source of capital for the type of investments that we're talking about today? It's very easy to do repeat investing. So once you make an investment and that investment runs full cycle, you can actually very quickly and easily redeploy those funds into a new opportunity. If you're not expecting to use the fund soon, again, this is a retirement account. So if you're a younger investor and you're not planning to retire, or you're well under the age 59 and a half, it's money that otherwise is just sitting there, maybe in a CD, a 1 to 2% return account, where you know some sort of way, or have found someone that knows a way that you trust to make better returns. And there's also no outside approval. Again, the key term here is self-directed retirement investing. You're the self, you pick the investments. Advanta IRA and your self-directed administrator, if they're truly a self-directed administrator, are not a fiduciary or financial advisor. So they should not be telling you what you can, or I'm sorry, what you should or should not invest into. They should really just be experts, as we are, in what you are allowed, so what you can and cannot invest into per the IRS's rule and regulation. That's what we're here for, to help you make your investments within the IRS compliance, but also let you guide your own decisions as to what you're investing into. And to that effect, it's always important to invest with people you know. Do your due diligence, make sure that you build your network and know your network. The triad of know, like, trust is something most people are probably already familiar with, but I can't stress enough, specifically with taking control of your own retirement funds, that you've done thorough due diligence before you make any specific investments. Advanta IRA puts out a lot of educational content. So as in today's webinar, we do webinars just like this 2 times a week. We also have a podcast called the Alternative Investing Advantage Podcast. And all of these resources we put out, also including our blog, are free educational components that we share for not only our client base, but our general network of people interested in retirement account investing, just to expand the knowledge and information. So if today's webinar is something that you find appealing, please feel free to share it with friends, family members, other colleagues or coworkers, and keep an eye out for other content that we put out. Maybe there's another topic you're also interested in. In any event, it's always free and it's always here to help you. So please reach out if there's any specific topic or interest that you'd also like us to cover or share. Now, as a brief disclaimer before I jump into my case study, Advanta IRA and its employees do not provide any tax, legal, or financial advice. We always implore you to do your own due diligence. All of the information that I'm going to speak about in my next case study and that I've already spoken about as well as what Jason is speaking about, is for educational purposes only. Again, please consult your own professionals before entering any specific investment or transaction. So I've got my case study here on how to make a private placement investment. So this is basically going to cover from the retirement account standpoint, how you would make a style of investment that is very similar to what Jason is going to be covering with his portion of the presentation in a few moments. So in my case study, I've got a gentleman named Arthur who has a large amount in an IRA with a fiduciary or financial advisor. And again, he's fatigued with the market. He just has started to look elsewhere for where he can invest his money and what he has a little bit more passion in than just letting someone drive his dollars. He meets Sandra over coffee to discuss investing into a local business. Sandra provides Arthur with what's called a PPM, or a private placement memorandum, which typically includes a subscription agreement, an operating agreement, and a prospectus for the investment. So he'll receive the paperwork of how that business is supposed to be run, the paperwork of what they expect that business to grow and to do in the future, and a subscription document should he choose to make the investment. Arthur opens up a self-direct account and completes a transfer request to move the money from his existing IRA into his new self-direct IRA. And once he turns in the paperwork, Advanta IRA really starts moving the wheel and getting the account set up, the transfer submit to his previous company to get the money moved over, and we even start coordinating the investment paperwork, again, that subscription agreement, with Arthur to be executed and ready to fund as soon as his money is in his account and the account's fully set up. So what this really looks like is making sure the subscription document, trying to make this investment and using his dollars from his tax sheltered Arthur when he's really trying to retirement account. These are very generous expectations. This is just rough numbers to show an example of what can take place. Arthur makes the investment into the subscription agreement. He funds about $100,000 into the deal. And after about 10 years, decides he no longer wants to hold ownership, and he decides to sell his ownership for $160,000. Throughout those 10 years, though, there's also the possibility for distributions to be made to the investors. So over the course of 10 years, he also periodically generated a total of $20,000 in distributions. So in total, over the 10 years that this investment was held and owned by Arthur's retirement account, there's about $80,000 generated, again, of either tax deferred or tax-free earnings. He will either have to pay taxes on that money as ordinary earned income when he distributes out of his retirement account later in life to use for retirement income purposes, or if it's a Roth account, he'll never pay taxes on that $80,000 of profit generated over those 10 years. So, what type of investor are you? If you're a more active investor and you like to have a little bit more hands-on capacity, then maybe the field or interest are driving you towards having property with rentals or rehab or wholesaling. There's more control, you have more of a decision-making capacity, and it's more hands-on, even with self-directed where you're supposed to be hands-off, but that's kind of the nature of the beast here. And the cons are that it's going to take you more time and energy and more responsibility on your part to make sure everything's flowing well. Whereas a passive income strategy is like a private placement, like we've discussed today. You're putting up your money after review and due diligence on what the general partnership team or ownership team of the deal plan to do with the investment. And then you're just sitting back, hoping that everything functions as it is expected and as it plans to, and receiving what we call mailbox money, or just return income generated from the money you've put out for the investment. There's little to no control over these investments aside, again, reviewing that operating agreement and reviewing that prospectus, and you don't make day-to-day decisions. That's why, again, it's important to do your due diligence and make sure you trust and thoroughly understand what that general partnership or ownership team are planning to do with the deal. It's very easy to get started with a self-directed account. If you contact me and we have a conversation about where your funds are coming from and what you plan to do with your account, I'll provide you an application via DocuSign. It typically only takes about 15 minutes to complete that application. And then we can get your account set up and ready to fund within about 10 to 14 days, speaking conservatively. It can be much quicker. It really just depends on where the funds are coming from and facilitating that process to get the other company to move the money over. Please feel free to reach me if I can answer any specific questions or help you further. And without further ado, I'm going to turn over to Jason for his portion of the presentation. Jason, the floor is yours.
Excellent. Thanks, Corey. I appreciate you having me. Let's go ahead and move forward to my agenda slide. All right, so for my piece of today's presentation, I'd like to focus a little bit first on just introducing myself, letting you know who I am and about the firm that I run, Fruition Capital. And then we'll talk a little bit when it comes to investing in small businesses, the opportunity that we see in the market. We'll talk about operating businesses in general as an asset class relative to many of the other asset classes you're likely already familiar with. We'll talk about the specific vehicles that can be used to access operating businesses because there are several of them, each with their own kind of pros and cons. And then I'll go into our Fruition Capital strategy specifically as it comes to tackling the opportunity that we see in the market. And we will finish up, as Corey mentioned, with some Q&A at the end there. So briefly about myself, I'm Jason Ehrlich. I started and run Fruition Capital with a team of several others that work with me. And our firm is focused exclusively on working with entrepreneurs that are acquiring stable operating businesses as their owners retire, kind of as Corey mentioned at the top of the introduction. I've been investing in alternative assets and managing those investments myself for the last 8 years or so. I've placed capital in 17 different private placements, the exact type of investment Corey was just talking about in his case study, into both individual assets and funds. I've got over 15 years of professional experience, and 5 of those have been as an entrepreneur myself. So I consider myself fairly experienced in sort of the end-to-end suite of skills that you need to succeed in this sort of investment type: underwriting, due diligence, the capital raise, transaction execution, the asset management, kind of all of that. As I mentioned, I do have a team around me that supports me in those activities. I have some of their bios and information further back in the appendix that you can look at should you have interest. Let's go ahead and move on to the opportunity that we see here. So this is an exciting space for us specifically, and I hope you find the same to be true. So I'll tell you sort of a little story about what we see in the market, why we're so excited about it. So small business ownership, it's more concentrated in a single generation with baby boomers than has ever been before in history. So in the segment that we're talking about, 55% or more of these small businesses are owned by boomers. So that's crazy concentration. And of course, we all know where the boomers are in sort of the demographic wave here. They are really being forced to retire and aging out of the workforce. This sort of transition of business ownership has been dubbed the $1 trillion tsunami or the silver tsunami. I kind of hear both things, but it's very much underway now and will continue sort of crashing, if you'll follow the wave analogy, for a number of years more. Specifically, businesses that we're looking at in this segment, they're under $2 million in EBITDA. EBITDA is usually the main measure of size for these businesses that's used. They're too small for private equity firms. And so acquisition multiples stay very, very low. But also, if we look at those that are north of $1 million, so really we're talking about $1 to $2 million in EBITDA, because if you're north of $1 million, it's too small for the unsophisticated mom and pop buyers. So you really have this nice niche in the middle where acquisition multiples and prices therefore remain incredibly affordable, and it is very much sort of a buyer's market in that niche. There's a high supply of these businesses and low demand, like I just mentioned, so we really have that buyer's market. In terms of who we're working with for operators, a growing number of the most sort of elite business schools are now teaching this concept, acquisition entrepreneurship, or ETA as it's sometimes referred to at entrepreneurship through acquisition. And it's focused on this niche that we're talking about. You get a small set of mid-career sort of searchers that are going to switch and try to find a business, but the vast majority of these folks are coming out of these business schools specifically trained to find the types of businesses that we're talking about and to subsequently operate them. And it's these entrepreneurs that our firm focus on investing in. So let's talk about operating businesses as an asset class. And I'm actually going to work my way sort of around the boxes here and come back to the punchline at the end. So publicly traded equities, everyone on this call is more than likely familiar with that, right? We know they're easy to access. They're out there. You can buy them through any number of different, brokers, investment houses and such. Good liquidity. You can buy and sell them same day. But like Corey mentioned, they are highly volatile. They'll go up and down based on, an an oil embargo happening in some sea on the other side of the world, and that will swing the price of a stock. That, why does that move? It's hard to see. They're very volatile. There aren't really great tax advantages associated with publicly traded equities themselves, and they are more expensive. When we think about business investing, in here we're talking about like EPS multiples. So, a stock will trade at 15, 20 times earnings, whereas in the space that we're talking about, it's 3 to 5 times earnings. So radically cheaper, different animals, different types of businesses, but the bang for your buck that can be had in this lower middle market segment, as it's referred to, is drastically different than publicly traded equities. Startups. So many have not invested in startups. Almost everyone's familiar with the concept, right? And of course, startups can deliver absolute home runs. If you find a good one and it's successful and it has an IPO, go buy your jet because you're in good shape. However, very high failure rate. It's north of 90% in terms of the number of startups that just completely go to zero and fail. It's also extremely illiquid because you're actually dependent on key events such as an IPO or a recapitalization to be able to get any money out of the business. They don't really cash flow and distribute the way operating businesses do. So very, very illiquid. And if you're going to pursue a startup strategy responsibly, you really need a large amount of capital to do that, because I say responsibly, of course, you could plunk money down on a single startup and just hope, you get lucky. But the folks that invest in startups, more systematically, they are placing their chips across 10, 20, 50 businesses, knowing full well that 90% will fail, but hoping that the 10% more than covers all the other losses. So it really requires a lot of money to do it responsibly. And it's also very opaque how the valuations of these things do, because they don't have long track records of revenue. People are sort of forecasting what growth could look like, what the market could look like, and multiple rounds of equity raised with different valuations at each round. So it's very, very difficult to get a sense of what a startup is actually worth at any point in time. And also there's private equity. I reference them because they tend to focus on much larger businesses. They can certainly deliver outsized returns relative to publicly traded equity. It's well known, well documented. But private equity is pretty difficult to access for everyday investors. And in general, it is a little bit of an exclusive club to be able to get money deployed through private equity shops. A number of them are, even closed off to the public, or they're working with large sort of institutions, family offices, things like that. Less accessible for you and I as sort of the everyday retail investor. Also fairly low liquidity, and also, not every private equity shop, but certainly some of them will employ business practices that some folks find objectionable, where, I have gutting in here as an example, where they may go in and sort of remove a lot from the business and to take out cost, fire people, reduce headcount, those sorts of things where, it would be probably good for returns, might not be the most socially responsible thing to do. So that's just a consideration in that space as well. Our box up here that we're focused on is just direct investment in operating businesses. So you get extremely attractive valuations like I've talked about. We're talking about multiples that are 3 to 5 times earnings. So potential for very high returns. Their failure rate is far lower than startups. So in the segment that we're talking about, $1 to $2 million EBITDA, and that are generally using SBA loans as the debt to facilitate this acquisition, their success rate, and success defined as actually keeping EBITDA at or above where it was at acquisition, is north of 90%. So it's quite literally the inverse of startups in terms of success rate. They also carry strong tax advantages. So many who invest through self-directed IRAs invest in real estate because of the tax advantages that can come along with that, and depreciation, things like that. So you do have the same in operating businesses. You can write off depreciation and amortization. Again, which type of account you're going to use will impact how you can take advantage of that, versus traditional, etc. So of course, talk to a tax advisor, but those advantages are available through direct operating business investment. The downsides, it's a very difficult to access private market. The odds that any given investor knows someone who's going to be acquiring one of these businesses, or multiple people who will be acquiring these type of businesses, it's low. It's quite difficult to sort of get into this community, find these people who are then going to find these businesses, and they're not raising tons and tons of capital either. It's a fairly small raise. So that's one part of our value proposition, is that we are very intimately connected to this acquisition entrepreneur, or searchers as they call themselves, community, to be able to forge these relationships, find the strong operators, and generate the deal flow needed to actually place a meaningful amount of capital here. Also, though, we should mention they do involve sponsor or key man risk, right? You do at the end of the day have someone who is buying this business, and if that someone gets hit by a bus, there's significant risk that can be associated there. So we never want to overlook or paper over that. We'll just call that out as, if you're buying a publicly traded business and the CEO gets hit by the bus, there's a COO that steps up. Generally not the case in these lower middle market businesses. So that's just something to be aware of. But in general, we like the direct investment in operating businesses better than sort of these other three vehicles that you can use to get exposure to business. Just our own thesis. Of course, everyone sort of makes their own decisions. So let's go ahead and move on to the next slide. So let's talk within the operating business asset class that I just sort of discussed, the blue box. There's three primary vehicles that can be used to access this asset class. And just like I did, I'm going to talk to the black text before we come back to the blue. So search funds. Anyone who is familiar with this acquisition entrepreneur space will have heard of search funds. They've been around for roughly 10 years. The concept was originated out of Stanford around that time, and they have a respectable track record. But what they do is they'll go to these MBA programs and they'll say, Mr. MBA or Mrs. MBA graduate, I'm going to pay you for 2 years, and your job while you're taking that salary is to just go out and find one of these businesses. But when you do, we the search fund own 70% of it, you own 30%. You're more like a paid CEO rather than a true owner operator. As an investor in a search fund, therefore, it's a very blind investment. You're giving the search fund your cash, hoping that they find good entrepreneurs, and subsequently that those good entrepreneurs actually find a good business to run. Because the search fund, they could pay a searcher for 2 years, and if they don't find a business during that 2 years, that's just lost sunk cost. So something to be aware of there. Also, search funds have a significant weight between investment and receiving distributions because of exactly the dynamic I just described, right? It's years potentially before they find the searchers, give the searchers money, searchers buy a business, and actually begin distribution. So there's a long sort of no distribution period there. There is, of course, direct investment in a business. So if you happen to know the guy who's buying this business and you just elect to give him the cash directly, that's great. There's no profit splits or fund expenses. There's no middleman, so to speak. You're just working directly with that person. That's great. We see no problem with that. But of course, like we mentioned, it's very hard to find those people, find the right deals. So that's the second point, right? It requires significant networking to create the deal flow. And also, you do have to know quite a lot about how these businesses operate to do the underwriting, to know if it's a good business, to do the due diligence and look out for those potholes. Due diligence is a main feature in real estate. It's about 10 times more important in operating businesses because there are so many other levers, things to consider, things that could go wrong. So that's another sort of the value proposition that we bring. We do all of our own underwriting in addition to what the searcher does, all of our own due diligence to check all the boxes and make sure we're looking out for as many of those potholes as we possibly can. And the other con, of course, of direct investment is it's not diversified in and of itself. You are plunking all your chips down on a single business. And if that one business happens to go under, we said 90% do great, but if you happen to grab one in that 10%, you have the potential to go to zero, which is never super attractive. A focus fund is the approach that we take. And that is essentially, we put together a specific thesis, a specific set of criteria, and then we're investing directly in these operating businesses, but we bring together 6 to 8, sometimes 9 operating businesses in a fund. So you have the benefits of direct investment, but you're with a single check exposed to, like I said, say 6 to 9 businesses that all look and smell alike. And we'll talk about sort of the criteria that we adhere to within our own strategy in a minute with a single check. So it provides that diversification. And like I sort of alluded to, your investments are directed by, if we can pat ourselves on the back, subject matter experts in the field, folks that live and breathe these type of businesses and know what we're looking for in terms of performance and risks and things of that nature. So those are sort of the three vehicles you can use to get at these operating businesses. So let's talk specifically about our strategy here at Fruition Capital, because there are a litany of different types of businesses out there. Some businesses are, turnarounds. Some businesses are very stable. Some are growth stories, on and on and on. We have a very specific sort of thesis, and it guides what we do with our fund investment. So we only invest in enduringly profitable businesses. So these are businesses that have 10 years or more of business history. They're producing durable earnings. So it's not that they just got to $1.8 million in EBITDA this year, but they've been doing that year over year over year. And specifically, we look for companies that are B2B companies with a large repeat customer base. It's not to say that normal B2C companies can't be enduringly profitable, but it's much harder to retain individual consumers as customers as compared to these businesses that we look at, which are B2B, where you could have the same companies buying from a business for 10, 15, 20, more than that years, where they are just buying year over year over year. So one of the things we analyze is the churn rate and how long customer tenure, how long have those same customers been buying from the company. And then you can always look under the covers and find out, why is that, right? Is there some sort of geographic moat, or are they some part of the supply chain that's just very hard to disintermediate? We understand the why, but we're in general looking for those repeat customer bases at B2B companies. We're looking for a specific market niche, right? So we're trying to stay out of businesses with large scale competitors or commoditization or things that could otherwise put undue pressure on the margins. We want to see sustainable barriers to competition. So again, if you have that repeat customer base that's producing the outcome that we like to see, most likely there is some sort of barrier, otherwise that condition wouldn't exist. So we like to get in there and figure out what is it that's protecting the company's position. And of course, that stable EBITDA that we're talking about has to be in that 1 to 2 million range, where you're too small for private equity, but you're too big for mom and pop to get in that very attractive sort of multiple space. We also have some no-nos, if you will, disqualifying criteria. So we don't invest in any businesses which are overly dependent on just a few key suppliers, or if a few very large customers make up a large chunk of their revenue where they have some dependence there. We don't like that either. We stay out of highly cyclical businesses, so things that are in industries like construction or energy, for example. We stay out of those. Similarly, tech businesses. So if our thesis is around enduring profitability, tech is probably the sector that is most rapidly changing, most subject to disruption and change. It's extremely difficult to be enduringly profitable in tech. So we generally stay out of that. And also, if you have a business that was, a one-man band, so to speak, which really doesn't tend to exist much in this 1 to 2 million EBITDA range, it's just generally too large for someone to accomplish that. But we do stay away from businesses that had a heavy reliance on the skill of the owner, because again, that introduces risk in the transition where the acquisition entrepreneur is coming in and buying that business. That's what we look about in terms of the businesses that we buy. We also have criteria for the acquisition entrepreneurs that we work with. The analogy I use all the time is horse and jockey, right? So the acquisition entrepreneurs, the jockey, we get to know them, and then they come to us when they actually have a business. Here's the horse I'm going to ride in the race. Do you guys want to invest in this? And at that point, we can say, we like you, we like the business, therefore we're making an investment, and we jump straight in, but rather than that kind of search fund, wait, hope that the person you like gets a good business, those sorts of things. So in general, our entrepreneur criteria, we want them to have conducted a self-funded search. So we want them to have put up their own money and their own time to go out there and find this business. Obviously, we're looking for track record, right? We want to see leadership and management history. Most of the folks that we're looking at have at least a decade in an adjacent or directly relevant sort of field. We want them to be running the acquired company as their full-time job. So we're not looking to buy into holding companies where the entrepreneur is going to buy 5 or 6 different businesses or whatnot. We're looking for just focused operators. We want them trained in this notion of acquisition entrepreneurship. It's much different than just starting a new business, or wildly different from a corporate role. That's why a lot of times we like to see an MBA from one of these top programs. It's down there in the bottom as preferred. It's not required, but it certainly helps to have that sort of specific training. A major one on here that should probably be bold and red and have a circle around it is that they're personally guaranteeing the acquisition loan. So I mentioned that SBA, Small Business Administration debt, is used in these acquisitions. It's kind of like a Fannie Mae or a Freddie Mac loan would be in real estate. It's that government debt, the gold standard for what's used here. It requires the acquisition entrepreneur to personally guarantee the loan. And so if you talk about alignment of interest, of course, you always like to see a sponsor who's investing their own capital, and at Fruition Capital, we do that as well. But I can't think of a better way to create alignment than to know that should a business go under, not only would the entrepreneur lose their investment, but they would have a personal bankruptcy because they're completely lashed to the business via that personal guarantee. So high alignment of interest. And of course, we like to see a high degree of integrity. That just goes to the process where we're getting to know these folks and checking for alignment of interest, checking their references, making sure that we're getting in with good actors. Because honestly, probably the single biggest risk in this space is entrepreneur risk. I talked about the key man getting hit by the bus, so to speak, but it goes the same way if you are investing in a low integrity actor. It doesn't matter how good the business is, you still stand to lose money. So that's generally our strategy, the criteria that we're looking for both businesses and the entrepreneurs. As you can probably glean from this, we're looking for stability. We look for predictability. This is not intended to be a speculative fund. I think we can say investing in operating businesses carries more risk than, say, just a big ETF, like a large market ETF. These are smaller operating businesses, but at the same point in time, far more stable, producing existing cash flow, distributions right off the bat. So relative to, again, investing in a single business or a startup or something like that, we're looking for stability in this particular market segment. Let's go to the next slide. So quickly on the benefits of our approach, I think we've talked to a lot of these sort of in context, so I'll just hit them quickly, but it does provide great diversification from traditional asset classes like the stock market, bonds, things like that. There's very, very low correlation in the types of businesses that we are buying versus the stock market. It absolutely has the potential for outsized returns, while at the same time avoiding that high failure risk that's associated with startups. We talked about the tax advantages already. It is passive, so Corey was talking about the types of investors, whether you're an active or a passive. So it really requires no involvement in the business itself. Once you decide to make an investment, you do sort of sit back and you receive regular monthly updates from us, and you receive the mailbox money via the distributions, but nothing is required from you beyond making the investment. As such, as a limited partner in these deals, your risk exposure is limited. So of course, with any investment, right, it's responsible to say you could lose the amount of your investment, could go to zero, but you could never lose more than that, right? Because you are an LP, and so something crazy happens, there's a giant lawsuit, the whole thing goes under, your risk exposure is limited to the amount of capital that you've invested. And lastly, I talked about that alignment of interest with those all-in entrepreneurs who are personally guaranteeing the debt. We just see that as such a huge factor in terms of creating that alignment of interest where we're all rowing in the same direction. Hopefully this was informative to you. It's a space that we are tremendously passionate about, not just small businesses as kind of a backbone of the American economy, but specifically in these acquisition entrepreneurs that are facilitating the handing of the torch from the baby boomers to the latest generation. It's, like I said, something we're very passionate about, something that we see as both having tremendous return and an attractive risk return profile, but also sort of as a social good to facilitate these businesses staying in their communities longer term, creating jobs, things like that. We just really love this space. So glad we could come on and share this with you today. Of course, if you want to learn more, please feel free to reach out to myself, Jason Ehrlich. You can reach me at jason@fruitioncap.com. I believe my information's also in the email that went out about the webinar. I shouldn't be too hard to find. So happy to have one-on-one conversations, discuss the funds that we are currently operating and have open for investment. You can reach me via that email there. And so with that, I know we're going to open up a Q&A session, so let me give the mic back to Corey to facilitate that.
Yeah, Jason, can you hear me?
I can.
Okay, perfect. Well, thank you very much for your detailed presentation here. I see someone has used the hand raise feature. Maybe they weren't here at the beginning. Please use the questions box on the GoToWebinar panel to add your questions for Jason. I do have a few here I'm going to start reading off, but again, please add those so that we can address them before the end of the session. We'll pretty much spend the rest of the time going over the questions as long as they keep flowing in, or until we reach right about the 1 hour mark. We do try to be respectful of Jason's time and your time as an audience and keep this right around 1 hour. So I'll go ahead and get started here. I think these first two actually were addressed for the most part during a few of your slides, Jason, but again, they came in from the audience, so let's just make sure we hit these home. Are the searchers paid a finder's fee, or do they receive capital in exchange for their research and due diligence to bring the deals?
Yeah, that's a great question. So the major upside that these searchers take is that they retain a significant portion of equity in the business. So they're not paid any sort of upfront finder's fee or search fee or anything like that, but they will retain 60, 70% ownership in the business while their investors retain 30, 40%. So they have a major stake and financial upside in the business, but it's all driven by the performance of the business and nothing is sort of a fee paid up front. It's a great question.
Got it. Next one here. Are there common businesses that are more prominent in this avenue? For example, laundromats, upholsters, or alteration seamstress, or other things that boomers have built up consistently that you guys are seeing?
It's a great question. Yes and no. So in terms of those types of businesses that were cited, I do want to mention again that we're exclusively focused on B2B companies. So, seamstresses, alterations, laundromats, all of those are B2C companies and would be outside of our scope. So examples of businesses that we would be interested in: a commercial towing and wrecker business that's, not your tow truck on the side of the road, but when you see semi trucks broken down, or you have fleets like, Amazon drivers, whatever, when they break down, those large wrecker crews that are out there, a business like that, or a business that's in the manufacture of specially coated wires and cabling that manufactured would use in like outdoor machinery, like a John Deere tractor. Or think of a business that goes around inspecting the fire sprinkler systems in every retail, office, multifamily building you've ever seen that has to be inspected per the law a certain number of times per year. And there's a company that just goes around and inspects and tests and all that. So I would say, no, there isn't. We're not just looking for a specific type of business. We have our very specific profile, but then within that profile, we actually like to touch different industry sectors and types to provide that additional sort of diversification within the fund.
Awesome. Next question here. Are any investment opportunities international, or are they solely domestic?
Yeah, it's a good question. It's exclusively within the US.
Okay. And the next one, comparing to the case study, what is a typical full cycle investment, both in context of timeline and minimum or maximum investment amounts for an investor?
So I'll quickly ask you, Corey, if I can answer that question. I know that this is more of an educational session and not a specific fund pitch. So you tell me if that's a inbounds question or not.
Yeah, the way I think it would be allowable, again, and what Jason's referring to for the audience is we do have compliance constraints on exactly what and how he can share. what is the typical full cycle, like in terms of years? And then I guess just a general example of a minimum or maximum that people typically invest in these types of deals without
Yeah,
getting, specific into one of your opportunities. Can you address
absolutely.
those?
Yeah,
Okay.
generically, sure. So I would say generically a hold period is something like 5 to 7 years. Um, there are usually cash flow events during that hold period, right? So A, distributions, B, oftentimes because of the way these investments are set up using preferred stock, entrepreneurs have an incentive to pay back the fund's capital sooner than a liquidity event like a sale at the end of the thing. So oftentimes there would be some sort of return of principal during that 5 to 7 year time horizon. A typical investment, I would say, is typically 75,000 at the bottom end, up to, let's say, 2 to 300,000.
Okay. And a caveat to that question, or to that answer more specifically that you just mentioned, and this is my own thing I'm adding. You mentioned earlier that what your team typically does is pull together, 7 or 8 businesses into a fund. Is that kind of the criteria there? If it's closer to 7 or 8 versus if it's, down to 3 or 4, the threshold there between 75 to, 100, 200K as far as a investment value?
No, yeah, the
No.
individual investors can make their own allocation decision. Usually, like I said, 75 is around the minimum. The fund is going to have that 6 to 9 businesses in there. Typically, each fund is around $5 million, let's say, in total capitalization. So the individual investor can make their own decision about how much they want to invest in the fund.
Okay, perfect. Um, I believe as of right now, that is the final question. So I will just at this point give the audience kind of a last call to add any additional questions that you guys may want Jason to answer. And while I'm giving you a few moments to think about those and type them out, Jason, is there anything else that you'd like to add or any, specific key points you'd like to make sure we really hit home with the audience about your topic today?
Yeah, thanks. I mean, I think we hit them in my summary here. Again, it's an asset class that we're very passionate about. We think it provides great diversification, strong potential for returns, while also sort of doing a social good at the same time. So no, I think we've been through the key points, and like I mentioned before, I'm very accessible. Feel free to email me directly. More than happy to answer specific questions that may come up after this webinar or discuss any interest in offerings that we have or will have in the future.
And that is a perfect exact segue to the thing that was typed out and sent to us as you were speaking there. Do we know which businesses are currently available in the current fund? And just to get ahead of that, I cannot really allow Jason to give that answer on this webinar because it's for educational purposes. So to the participant that asked that, please take Jason's email address down and reach out to him directly. Also, if you download the PDF version of the slide deck, I believe I also provided his phone number. Jason, is that something you did want shared with the audience?
Yeah, absolutely. And
Okay.
I'll just say,
So
while we
give him a
can't
call.
talk specifically, I can say that generically the answer is yes. Investors who are investing in an open fund have complete transparency to the businesses that are already in the fund.
Perfect. All right. I believe that concludes the webinar. Again, I implore the person that posted those questions to reach out to Jason directly, whether it's a phone call or an email. He's mentioned multiple times he's very accessible and looking forward to speaking with you all. If you are watching us live today, the recording should be up on Advanta IRA's YouTube page within about a day or two, so you can watch back at your own pace and get into all the nitty-gritty notes and details that we've covered today. Thank you very much for joining us. Jason, thank you very much for bringing your expertise and knowledge to the table. Really liked having you on and look forward to doing this again in the future.
My pleasure. Thanks for having me.
All right, thanks everybody. See you next time.